You know, despite the recent price action for Bitcoin, we are seeing the most unrelenting stream of bullish news for the asset that we have arguably ever seen. The chairman of the Commodity Futures Trading Commission was just confirmed, and his name is Mike Selig, and he ran the SEC's crypto task force. We're going to read through the statement right here because it's incredibly bullish. He is very honored to be confirmed as the 16th chairman of the CFTC. He wants to thank Donald Trump and the Senate Ag Committee and the U.S. Senate for a smooth and speedy confirmation, and then David Sachs for his leadership in revitalizing American entrepreneurship, innovation, and productivity by modernizing legacy regulations and cutting red tape. All of these nice thank yous are great, but then we have to get to paragraph number 2, where we start to understand why this is bullish. He says, "Today begins a new chapter for the CFTC. We are at a unique moment as a wide range of novel technologies, products, and platforms are emerging. Retail participation in the commodity markets is at an all-time high, and Congress is poised to send the digital assets market structure legislation that will cement the U.S. as the crypto capital of the world to the president's desk. He is welcoming the vital responsibility to oversee the stability and the security of America's commodity derivatives market during this period of rapid transformation." This is a key phrase right here, folks. No agency is better suited to pioneer common sense rules of the road for new financial markets of America's golden age. Listen to this bullish sentence. "Under my leadership, the CFTC will conquer these great frontiers and ensure that the innovations of tomorrow are made in America onwards." Now, this is someone who understands digital assets well enough to regulate them without panicking. Bitcoin bears, they hear the term regulator and then they immediately assume prohibition, prison time, and a 90% drawdown because their entire worldview was built during the Obama administration and never updated. Remember, the Bitcoin bears, they still think that regulation means a SWAT team rappelling through your Coinbase app. What actually happens, though, is that jurisdiction gets clarified, rules get written, and capital that was sitting on the sidelines quietly moves in while Twitter is still arguing about decentralization purity tests. This appointment is directional bullishness for Bitcoin as an asset. It tells you which agency is being empowered, and I am going to explain to you why this is incredibly bullish for Bitcoin. Now, I want to talk about something that the Bitcoin bears just refuse to learn because, remember, it would require reading. Bitcoin does not fit inside securities law as much as it fits under commodity law. Because if you talk about Bitcoin as a security, you gotta remember that with Bitcoin, there's no issuer of the asset, no management team, no promise of cash flows. There is no equity claim. There is no quarterly earnings call with some guy in some vest lying to analysts. So that entire framework collapses immediately. So when the bears start screaming that the SEC is coming, what they are really saying is that they do not understand how U.S. financial law works, but they feel emotionally comforted by authority. The key point here is that Bitcoin trades globally, continuously, without permission and without a centralized sponsor. And if you're paying attention, that's exactly how commodities behave. Because oil doesn't have a CEO, gold doesn't file a prospectus, and wheat does not issue stock options. They trade through futures, options, and derivatives because mature markets always do. That world is regulated by the CFTC. The CFTC exists to do one thing well. They manage systemic risk without pretending that it can control human behavior. The SEC's entire culture is disclosure, enforcement, and paperwork theater, but the CFTC's culture is market function. The Bitcoin bears want Bitcoin shoved into securities law because it would be awkward, slow, and confusing. They are rooting for friction because friction is the only thing holding their thesis together. This appointment, though, it signals that the government is done forcing Bitcoin into a legal category that does not apply, and jurisdiction always follows reality eventually. And just a heads up, when that happens, capital follows jurisdiction. And when capital follows jurisdiction, price stops caring about your Reddit thread from 2017. The bear case against Bitcoin is dying quietly because Bitcoin is going to be regulated where it actually belongs. So the argument is going to become valuation and not legality anymore. And most Bitcoin bears have never made it past legality. And now we get to the part where the feelings of the bears stops mattering because every asset is priced as a discounted future. And that includes Bitcoin, whether people like it or not, because the discount rate reflects risk, monetary risk, volatility risk, liquidity risk, and regulatory risk. We all know that Bitcoin has spent 16 years carrying this extra regulatory risk premium because nobody could answer a simple question: who actually oversees this thing? So investors apply a higher required return. That does not mean that they hate Bitcoin necessarily. That means that they price uncertainty honestly, which is more than most governments do. What regulatory clarity does is remove one entire category of risk. And I'm not talking removing it partially or rhetorically. I'm talking structurally. When the jurisdiction of Bitcoin is clear, the compliance costs, they become very predictable. When compliance is predictable, institutions can actually model outcomes. And when outcomes can be modeled, that means that capital stops treating Bitcoin like it's some freak legal experiment and starts treating it like an allocatable asset. You have to understand that there's all these Bitcoin bears out there. They think that the price only moves because of vibes, tweets, and astrology. But what they are failing to understand is that most capital that's in the world cannot buy something unless the lawyers sign off first. You understand that there are things called mandates. So this appointment is going to lower the legal uncertainty embedded in Bitcoin's future cash equivalent utility. You see, lower uncertainty means a lower discount rate. A lower discount rate means the same future adoption supports a higher present price. Nothing about this requires new users, new narratives, or new technology. It literally only requires removing doubt, and that's why it's dangerous to the bears, because remember, these folks, they need uncertainty. They need Bitcoin to stay legally ambiguous, so their fear sounds rational to them. And as soon as that ambiguity collapses, well, their thesis collapses with it. What remains is supply, demand, and time, and none of those things are on the bear side. And now it's time to get to the part of the conversation here. It's going to scare people who think that Robinhood is a trading desk. Every single large pool of capital in the world uses derivatives, and not for gambling or risk management, but for balance sheet efficiency and regulatory compliance. If an asset cannot be hedged, it cannot be sized. And fun fact for you, if the asset can't be sized, that means it can't be owned in any meaningful quantity by institutions that answer to boards, auditors, and regulators. The Bitcoin bears, they love pretending derivatives are some kind of moral failure, but that's because they don't understand capital allocation. They think spot buying is the end of the story because that is as far as their experience has ever gone. The CFTC oversees futures, options, and structured exposure, and when that framework is clear, Bitcoin stops being operationally awkward. We know that funds can hedge downside. We know that the treasurers can smooth volatility and banks can intermediate exposure without any legal ambiguity. And this is just going to increase market depth. It's going to increase liquidity, and it's going to increase capital velocity into Bitcoin. You see, what actually happens is more capital competing over the same fixed supply that Bitcoin has, but now they will be using more efficient instruments that compress volatility over time and increase the scale of participation. We've seen this continue to be a trend with all of the good regulatory news out there, and this is why everybody's scared of Bitcoin a little bit right now, because we are in uncharted territory. We have never seen this much liquidity where the OGs can sell their Bitcoin, because we're seeing this level of acceptance that the asset literally has never had. When you look at all of the other mature assets, what do they have in common? That they scale through derivatives first and speculation second. And Bitcoin is simply following that same exact path 16 years later, while the critics are pretending that this is all very concerning. So the truth might be boring for some people, but the reality is that derivatives are how assets graduate from fringe to infrastructure. And once Bitcoin becomes infrastructure, well, disbelief stops mattering. And now we move from traders to adults, because this is the part of the market that Bitcoin bears never model, because it requires understanding how companies actually make decisions. When it comes to corporate treasuries, they operate on policies, on accounting rules, on legal defensibility, on whether a CFO can explain the decision without getting fired. You see, for years, Bitcoin failed one test that mattered more than all the others, something called defensibility, not technological, not economic, institutional. If something blows up, the first question a board asks is very simple. Who said that this was allowed? And regulatory clarity answers that question in advance. Clear CFTC oversight means clearer guidance for auditors, lawyers, and risk committees. It means hedging tools exist that satisfy the internal controls. It means that volatility can be managed instead of tolerated. This is why treasuries move slowly and then all at once. There are a lot of people out there who think that corporate Bitcoin adoption is some type of edgy rebellion. It is actually one of the most conservative reactions imaginable to a world where cash yields nothing, liabilities compound, and governments dilute silently. Bitcoin becomes the asset that can be explained in a memo instead of apologized for in a deposition, and that is the underlying shift that we're living through. Once an asset can actually live in a balance sheet without career risk for the CFO, it stops being optional and it starts to be very competitive. And competition, fun fact for you, competition forces adoption even among people who hate it, which is exactly how most technological transitions happen. This is where Bitcoin stops asking for permission and starts showing up in quarterly filings, quietly, repetitively, and permanently. Now let's address the part that everybody lies about, okay? This is political. Everything involving money at scale is political. Regulation doesn't happen in a vacuum, guided by pure ethics and well-meaning bureaucrats who read Bitcoin white papers. That fantasy ends the moments that real capital is involved. What matters is alignment. We're talking who benefits, who collects taxes, who attracts capital, who keeps the markets onshore instead of watching them migrate. So this appointment did not happen accidentally, kids. It reflects a very strategic decision to integrate digital assets into the US financial system instead of watching them leave. We're starting to see that the governments of the world aren't going to be banning things that they can tax, regulate, and dominate. They are going to absorb them. They are going to build frameworks around them. They are going to let institutions turn them into infrastructure. A lot of people out there are a bit naive, in my humble opinion, thinking that the state is coming to shut it all down, despite 16 years of evidence now that the state mostly shows up late and asks how to get paid. And this is Bitcoin being pulled inside of the tent. Not because it's loved necessarily, but at this point, Bitcoin is just too large to ignore and too valuable to lose jurisdiction over. And this is how power behaves when it comes to all commodities. You see, once something becomes a matter of national competitiveness, it stops being optional policy. It becomes a priority to the United States, which means that capital gets certainty, institutions get their legal cover, and Bitcoin gets something that, yeah, it never needed, but always benefits from: endurance. Now we put it all together in the structural bull case. What is happening with Bitcoin? We know that the ETF solved access. We know that derivatives solve scale. We know that treasury adoption of the asset solves permanence, and regulatory clarity solves survivability. This appointment matters because it removes yet another tail risk. I'm not talking Bitcoin volatility or drawdowns or existential uncertainty. Remember, the people obsess over price action because they cannot attack the structure that is being built. These people, they argue in cycles and sentiment and narratives because those are the only battlegrounds left. What they cannot argue against is Bitcoin integration. You see, once an asset is being regulated by the agency that already governs its market behavior, used by institutions that already manage systemic risk, and held by balance sheets that already think in decades, the debate changes. It stops being about whether Bitcoin survives. It becomes about how much exposure to the asset is optimal. That question does not produce zero as an answer. This is how assets graduate. It's just factual. We've seen it happen time and time again throughout history. It's quietly, it's bureaucratically, without permission from commentators who built their entire identity around disbelief. You see, Bitcoin doesn't need mass adoption tomorrow. It needs fewer reasons to be excluded. And every time that one of those reasons disappears, the future gets pulled forward, and this appointment pulls it forward. Not loudly, not emotionally. I am talking structurally, and structure is the only thing that wins in the end. It's very obvious that all of this regulatory clarity coming to the forefront regarding digital assets and Bitcoin, it is providing a ground for incredible movements in the future. We know that the asset is being adopted, so it's time to be patient. And if you're watching all of these bullish developments happen about Bitcoin, and you want exposure before further shifts happen, well, now is the time to do it the right way. The Swan private team works with high net worth families, individuals, and companies who want to build generational Bitcoin positions safely, securely, and strategically. We help clients understand the macro forces like this that are driving the transition and how to own real Bitcoin and not paper IOUs. Because the goal isn't to survive the next crash, it is to survive and thrive through all of them. Visit swan.com/nosecondbest to learn more. Like this video and subscribe to Swan. We are bringing you daily Bitcoin insights during the greatest wealth transfer in the history of humanity. We are going to lead every single step of the way, and we love you here with us. Have a terrific day. Do not party too hard. Class dismissed.